There is a theft happening right now. In your bank account, in your paycheck, in every financial decision you make without the knowledge to make it correctly. And the thieves are invisible because they operate in the space between what you know and what you should have been taught. $246 billion. That's how much Americans lose annually because of what they don't know about money. This figure represents pure knowledge gaps. Overdraft fees that could have been avoided, high interest debt that could have been refinanced, investment returns that were left on the table, scams that could have been recognized. The average American loses somewhere between $950 and $1,000 every single year due to insufficient financial knowledge. Think about what that means over a lifetime. $1,000 a year for 40 working years is $40,000. But the real cost is exponentially higher because that money, properly invested at a modest 8% annual return, would have compounded into over $270,000 by retirement age. That's the difference between working until 70 and stopping at 62. That's 5 years of retirement income. That's a down payment on a house, gone, because the information was never delivered. The people who benefit from your ignorance have zero incentive to educate you. Credit card companies profit when you don't understand how compound interest works against you. Car dealerships profit when you can't calculate the true cost of ownership. Banks profit when you leave your money in accounts earning a fraction of a percent while they lend it out at 20 times that rate. The entire financial services industry has been built on the foundation of your confusion. 87% of Americans say high school left them unprepared for handling money in the real world. Only 19% took a personal finance class before graduating. Nearly half of all American adults grade their own financial knowledge at a C or worse. And perhaps most damning of all, only 48% of U.S. adults are considered financially literate by any objective measure. That number has barely moved in 8 years. 1 in 3 American adults often feels stressed because of money, chronically. That stress follows you to work. It sits with you at dinner. It wakes you up at 3 in the morning. It damages relationships. It affects your health. And for most people, it's completely unnecessary. The knowledge that would eliminate that stress exists. It's straightforward, it's accessible. It simply hasn't been properly delivered. 72% of Americans say they would have made fewer money mistakes if they'd learned personal finance in school. 73% say they'd be further ahead financially. 71% say they'd feel less stress around money. These are the regrets of millions of people looking back at decades of preventable errors. This is everything they never taught you about money. In the next hour, I'm going to walk you through the complete financial literacy curriculum that should have been mandatory education. From understanding exactly where you stand right now, to building systems that automatically grow your wealth. From the mechanics of credit and debt, to the psychology of spending. From emergency funds to investment accounts. From buying cars without getting destroyed, to deciding whether homeownership makes sense for your situation. This is educational information, not financial advice. I'm not a financial advisor. I don't know your specific circumstances, your income, your debts, your goals, your risk tolerance. What I'm giving you is foundational knowledge that allows you to make informed decisions. The framework that lets you evaluate opportunities. The vocabulary that lets you have intelligent conversations with actual financial professionals when you need them. By the end of this video, you will understand more about money than most Americans learn in their entire lives. Because you stayed. Because you recognize that ignorance has a price, and that price compounds just like interest. Let's start at the beginning, with the question most people never ask themselves honestly. Where exactly do you stand right now? There's a quote that applies perfectly here. If you do not know where you come from, then you don't know where you are. And if you don't know where you are, then you don't know where you're going. This couldn't be more true when it comes to your finances. Yet most people skip this step entirely. They have a vague sense that things are okay or that things are bad without ever quantifying what okay or bad actually means in dollars and cents. Before you can make any real progress, you need a clear and honest snapshot of your money, your income, your spending, your net worth, and most importantly, the gap between them. 3 numbers should live in your head at all times. Your net income per year, your expenses per year, and your income surplus or deficit for the year. Why yearly instead of monthly? Because a yearly view captures everything. The one-off expenses, the surprise bills, the insurance premiums you pay quarterly, the birthday gifts, the car repairs, the annual subscriptions you forget about until they charge your card. A monthly view misses these patterns. A yearly view reveals them. Start with your net income, the money that actually lands in your bank account after taxes and deductions. If you're on a salary, take your monthly payslip number and multiply by 12. If you have variable income, look at the last 12 months of actual deposits. Include everything: salary, side hustles, dividends, freelance work, rental income, interest, the total annual amount that flows into your accounts. Then look at your yearly expenses. Use whatever method works for you: bank statements, budgeting apps, spreadsheets. The tool doesn't matter. What matters is capturing reality, what you actually spend rather than what you think you spend. Include the obvious recurring bills: rent or mortgage, utilities, insurance, phone, internet, subscriptions. Include the less obvious categories: groceries, dining out, entertainment, transportation, clothing, travel, gifts. And include the things you typically forget: annual fees, maintenance costs, the random Amazon purchases that add up to hundreds of dollars without you noticing. Now subtract your expenses from your income. That number tells you everything. If it's negative, you're in income deficit. You're spending more than you're earning. Every month, every year, you're moving backward. Deficit spending doesn't just keep you from building wealth, it actively destroys wealth. It creates debt, it eliminates options, it makes every unexpected expense a crisis. If it's positive, that's your income surplus, the money left over after you've lived your life. And this is the number that determines your future. Because your income, important as it is, only buys you your lifestyle. Your surplus is what buys you your freedom. The bigger the gap between income and expenses, the faster everything happens. The faster you can save, the faster you can invest, the faster you can pay off debt, the faster you can accumulate the financial cushion that lets you say no to bad situations and yes to opportunities. Someone making $200,000 a year who spends $200,000 a year is no closer to financial freedom than someone making $50,000 who spends $45,000. The high earner might actually be further from freedom because their expensive lifestyle creates golden handcuffs. They can't walk away from a terrible job because the job is the only thing sustaining a life designed to consume every dollar it generates. Now let's talk about net worth. This is the ultimate measure of where you stand. Everything you own minus everything you owe. Assets minus liabilities. Assets are things that have value: savings accounts, investment accounts, retirement funds, real estate, vehicles, valuable possessions. Add them up. What could you sell everything for today? Liabilities are debts and obligations: mortgages, car loans, student loans, credit card balances, personal loans, medical debt. Add those up too. The difference is your net worth. For many Americans, especially younger ones, this number is negative. Student loans exceed assets. Credit card debt overwhelms savings. That's okay. It's a starting point, not a verdict. What matters is direction. Is that number moving up over time or moving down? Total U.S. household debt hit $18.59 trillion in late 2025. The average consumer owes over $104,000. These numbers have been climbing for years. You don't want to be average here. You want to be deliberate. You want every financial decision to push your net worth in the right direction. Here's the key insight that changes everything. Your income is the thing that buys your lifestyle, but your net worth is the thing that buys your freedom. Don't confuse them. A high income with a low net worth is a treadmill. You're running fast but going nowhere. A moderate income with a growing net worth is a path. You're building something that will eventually sustain you without your labor. One more thing before we move on. Your money personality matters more than most people realize. How you view money, how you relate to it emotionally, has a massive impact on how you save, spend, and invest. Some people are natural savers who find security in watching balances grow. Others are natural spenders who find joy in experiences and purchases. Some are risk-averse, wanting safety above all else. Others are comfortable with volatility if it means potential upside. There's no right or wrong personality, but certain strategies work better for different personalities. A spender trying to follow a miser's budget will fail and feel terrible about it. An investor who's deeply risk-averse will panic sell at the worst possible times and lock in losses. Understanding yourself, your tendencies, your triggers, lets you build systems that work with your psychology rather than against it. If you tend to spend impulsively, you need automation that removes money from your checking account before you can touch it. If you tend to avoid financial decisions, you need scheduled reviews that force you to engage. If you tend to be overly cautious, you might need to deliberately push yourself towards slightly more aggressive positions. If you tend to chase returns, you might need guardrails that prevent you from gambling with money you can't afford to lose. The goal isn't to change who you are. The goal is to design systems that account for who you are. To take your path of least resistance and make sure it leads somewhere good. Now that you know where you stand, let's talk about the force that keeps most Americans trapped: debt. Americans owe $1.277 trillion in credit card debt alone. That figure represents just credit cards. It excludes mortgages, auto loans, student loans, and everything else. That number has been climbing steadily, and it represents something important. Millions of people are paying interest on money they borrowed to buy things they may no longer even remember purchasing. The average household credit card balance exceeds $11,500 as of late 2025. At current average interest rates, which exceed 22% for accounts carrying balances, that $11,000 costs over $2,500 per year in interest alone, just to stay still, just to avoid falling further behind. Every month, hundreds of dollars flow from ordinary families to credit card companies. These payments often don't pay down the original purchases, they just cover the privilege of having borrowed the money. Credit card rates currently range from about 6% at the lowest to 36% at the highest, depending on your credit worthiness. The average offered rate for new credit cards hovers around 22%. With excellent credit, you might see rates in the high teens. With fair or poor credit, you're looking at mid-20s or higher. Let me show you what these numbers mean in practice. Say you have $5,000 in credit card debt at 21% interest. If you only make minimum payments, typically around 2% of your balance each month, you will be paying off that debt for over 2 decades. You will pay over $7,000 in interest on top of the $5,000 you originally borrowed. The television or vacation or furniture that created that debt will be long forgotten, but the payments will continue. This is the essential thing to understand about debt. It compounds against you the same way investments compound for you. Every month you don't pay in full, interest is calculated on your balance. That interest gets added to your balance. Next month, you're paying interest on the interest. The math that can make you wealthy is the exact same math that can keep you poor, just running in the opposite direction. Here's the thing about debt that most people miss. Distinction matters. Understanding the difference between good debt and bad debt is essential for making smart financial decisions. Good debt is money borrowed as an investment that will pay off over time. A student loan that enables you to earn significantly more than you would without the degree can be good debt, assuming the cost-benefit math actually works out. A mortgage on a reasonably priced home in a solid market can be good debt, because you're building equity in an appreciating asset while having somewhere to live. A business loan that allows you to generate more income than the cost of borrowing can be good debt. The pattern remains consistent. You're borrowing money that will ultimately produce more value than it costs. Bad debt is everything else. Credit card balances carried month to month on purchases that don't increase your earning potential or appreciate in value. Car loans for vehicles more expensive than you need. Personal loans to fund lifestyle expenses. Payday loans, which are almost always catastrophic. This kind of debt doesn't build anything. It just extracts wealth from your future self and transfers it to lenders. The most dangerous debt isn't always high-interest debt. It's normalized debt. Debt that feels so common, so universal, that it stops feeling like a problem. Everyone has a car payment. Everyone has credit card debt. Everyone has student loans. When debt is universal, it stops triggering alarm bells. It just feels like life. But look at those numbers again. Total consumer debt exceeds $104,000 per household. Ages 40 to 49 hold $4.8 trillion in debt collectively, the highest of any age group. These aren't people who made one bad decision. These are people who made many normal decisions that added up to a financial anchor they'll drag for decades. If you currently have debt, you need a strategy. Two main approaches exist, and both work. The debt avalanche method is mathematically optimal. You list all your debts and rank them by interest rate, highest to lowest. You make minimum payments on everything except the highest rate debt, and you throw every extra dollar at that top debt until it's gone. Then you move to the next highest rate. This approach saves you the most money because you're eliminating your most expensive debt first. The debt snowball method is psychologically optimal. You list all your debts and rank them by balance, smallest to largest. You make minimum payments on everything except the smallest balance, and you throw every extra dollar at that smallest debt until it's gone. Then you roll those payments to the next smallest. This approach builds momentum because you see debts disappearing quickly, which keeps you motivated. Which should you choose? The one you'll actually stick with. The mathematically perfect plan you abandon is worse than the slightly less efficient plan you follow through on. If you need quick wins to stay motivated, snowball. If you can stay disciplined regardless and want to minimize interest paid, avalanche. Both are infinitely better than making minimum payments forever. One more practical tip. If you have credit card debt, look into balance transfer cards. These allow you to move existing debt to a new card with 0% interest for a limited period, typically 12 to 21 months. This doesn't erase your debt, but it gives you breathing room. It stops interest from piling up while you're paying down the principal. Be mindful of transfer fees, usually 3 to 5% of the amount moved, and have a clear plan to clear the balance before the promotional period ends, because the rate that kicks in afterward is usually brutal. Now let's talk about credit itself, because understanding credit is the key to both avoiding bad debt and accessing good debt on favorable terms. Your credit score is a number between 300 and 850 that attempts to measure how likely you are to repay borrowed money. The higher your score, the more creditworthy you appear to lenders, and the better terms you'll receive. The difference between excellent credit and poor credit isn't just whether you get approved for loans, it's what those loans cost you. With excellent credit, you might get a mortgage at the lowest available rates, saving you tens of thousands of dollars over the life of the loan. With poor credit, you might pay several percentage points more, or fail to qualify at all. With excellent credit, you might get approved for premium credit cards with substantial rewards and benefits. With poor credit, you're looking at secured cards, high fees, and rates that make carrying any balance catastrophic. Your credit score is calculated based on several factors. Payment history accounts for about 35%. This is the most important factor. Do you pay your bills on time? Every time? A single missed payment can damage your score for years. Late payments, collections, bankruptcies, they all show up here and they all hurt. Credit utilization accounts for about 30%. This measures how much of your available credit you're using. If you have a credit card with a $10,000 limit and you're carrying a $5,000 balance, your utilization is 50%. That's too high. Lenders get nervous when they see high utilization because it suggests you're stretched thin. Ideally, you want to keep utilization below 30%, and below 10% is even better. The counterintuitive part, having credit cards with high limits that you barely use, actually helps your score because it shows you have access to credit but don't depend on it. Length of credit history accounts for about 15%. Longer histories are better. This is why you should be cautious about closing old credit cards even if you don't use them. That old card is contributing to your average account age. Credit mix accounts for about 10%. Having different types of credit, credit cards, installment loans, mortgages, shows you can handle various forms of borrowing responsibly. New credit inquiries account for about 10%. Every time you apply for credit, a hard inquiry hits your report. Too many inquiries in a short period suggests you're desperate for credit, which makes lenders nervous. Space out your applications. Here's what doesn't affect your credit score: your income, your employment status, your bank account balances, your age, your race, your gender. The score is purely about how you've handled borrowed money in the past. If your credit score is lower than you'd like, you can improve it. Pay every bill on time, every time. Set up auto pay for at least the minimum payment on everything. Pay down credit card balances to reduce utilization. Don't close old accounts unless they're costing you money. Don't apply for new credit unless you actually need it. Check your credit reports for errors and dispute anything incorrect. Building good credit takes time. Damaging credit can happen in a single missed payment. The asymmetry is brutal, but navigable if you understand it. Now, about credit cards themselves. They are simultaneously one of the best and worst financial tools available, depending entirely on how you use them. Used correctly, credit cards are magical. They build your credit history. They offer purchase protection and fraud protection. They provide rewards, cashback, travel points, statement credits that amount to a 1 to 5% discount on everything you buy. Some cards offer extended warranties on purchases, travel insurance, rental car coverage, airport lounge access. All of this for zero cost if you pay your balance in full every month. Used incorrectly, credit cards are wealth destroyers. That 20+% interest rate kicks in the moment you carry a balance. Those rewards you're earning become meaningless when they're dwarfed by interest charges. The convenience of swiping becomes the convenience of spending money you don't have on things you don't need. The rule is simple. If you pay your balance in full every month, credit cards are a tool that pays you to use them. If you carry a balance, credit cards are a trap that extracts money from you constantly. If you can't trust yourself to pay in full every month, you're better off using a debit card. You'll miss out on rewards and some protections, but you'll avoid the compound interest trap that destroys so many people. There's no shame in this. Knowing your limits and designing around them is wisdom, not weakness. One final note on debt: avoid payday loans at all costs. These short-term loans advertise themselves as quick fixes for cash emergencies, but their interest rates are astronomical, often 300 to 800% APR when calculated annually. They're designed to trap people in cycles of borrowing, where each loan requires another loan to pay it off. If you're considering a payday loan, almost any alternative is better. Selling something, borrowing from family, negotiating a payment plan with whoever you owe. Even credit card debt, as expensive as it is cheaper than payday lending. Now that you understand where you stand and how debt works, let's talk about where you're going. Let's talk about goals. Without a destination, you can't plan a route. Without financial goals, you can't build a financial plan. This sounds obvious, but most people skip this step. They have vague aspirations: be comfortable, retire someday, have enough, but they've never translated those aspirations into specific, measurable targets. The difference between a dream and a goal is specificity. I want to be rich is a dream. I want to have $500,000 invested by age 50 is a goal. You can build a plan around the second one. You can calculate how much you need to save monthly, what rate of return you need, how much time you have. The first one is just a feeling that never becomes action. Financial goals fall into 3 time horizons. Short-term goals are anything happening in the next 1 to 5 years. Building an emergency fund, saving for a vacation, paying off a specific debt, buying a car, accumulating a house down payment. These goals require safe, accessible money. You can't afford to have this money drop 30% right before you need it, so it belongs in savings accounts, money market accounts, or certificates of deposit, not the stock market. Medium-term goals are anything 5 to 15 years out. A larger house, starting a business, funding a child's education. These goals can tolerate some market exposure because you have time to recover from downturns. A mix of stocks and bonds, adjusted for your risk tolerance, makes sense here. Long-term goals are anything 15 years or more away. Retirement is the big one for most people. These goals should be heavily invested in growth assets like stocks because you have decades for compound growth to work and decades to recover from any crashes along the way. Here's why this framework matters. Where you put your money depends entirely on when you need it. Money you need next year doesn't belong in stocks. Money you don't need for 30 years doesn't belong in a savings account earning 4%. Matching your money's location to your money's timeline is one of the most important decisions you'll make. For each goal, get specific. What exactly do you want? How much will it cost? When do you need it? Write these down. Then work backward. If you need $50,000 in 10 years and you're starting from zero and you expect a 7% average return, you need to invest about $300 per month. Now you have a target. Now you can build a system around that target. Speaking of systems, let's talk about budgeting. The word makes most people cringe because it conjures images of spreadsheets and deprivation and tracking every coffee purchase. But budgeting doesn't have to be painful. At its core, budgeting is just a plan for your money. It shows how much comes in, how much goes out, and where it goes. Having a plan beats hoping things work out. The most popular framework is the 50-30-20 rule. 50% of your after-tax income goes to needs: housing, utilities, groceries, transportation, insurance, minimum debt payments. 30% goes to wants: dining out, entertainment, hobbies, vacations, anything that improves your life but isn't strictly necessary. 20% goes to your future: savings, investments, extra debt payments. These percentages aren't commandments, they're starting points. If you live in an expensive city, your needs might consume 60% of your income. If you're aggressively paying off debt, you might put 40% toward your future. The framework is meant to be adjusted, not followed blindly. Here's what matters: awareness and intention. Knowing where your money goes and deciding in advance where you want it to go. Most people have no idea what they spend on restaurants or subscriptions or random Amazon purchases. They check their account, it's lower than expected, and they have no idea why. A budget eliminates that mystery. It turns unconscious spending into conscious choices. The mechanics can be as simple or complex as you want. Some people track every transaction in detailed spreadsheets. Others use apps that automatically categorize their spending. Others use the envelope system, cash in physical envelopes for different categories, and when the envelope is empty, that category is done for the month. Others just automate their savings and investments at the beginning of each month and spend whatever's left without tracking it. The best system is the one you'll actually use. A complex system you abandon after 2 weeks is worthless. A simple system you maintain for years is transformative. Here are some quick wins that make a meaningful difference without requiring lifestyle sacrifice. Call your utility providers, cell phone carrier, and internet company. Ask for better rates. Tell them you're considering switching to a competitor. They'd rather keep you at a lower rate than lose you entirely. This takes 30 minutes and can save hundreds of dollars annually. Review your subscriptions. Most people are paying for services they forgot they signed up for or no longer use. Streaming services, gym memberships, software, apps, subscription boxes. Cancel anything you haven't used in the last month. Compare insurance rates annually. Auto, home, renters, whatever you have. Rates vary significantly between companies, and loyalty rarely pays. Getting quotes takes an hour and can save you hundreds. Use per-unit pricing when shopping. The price on the shelf doesn't tell you much. The price per ounce, per pound, per unit tells you which option is actually cheapest. This is especially true for staples you buy repeatedly. A few cents saved on something you buy weekly adds up over a year. Buy generic for commodities. Store brand medications are chemically identical to name brands. Store brand staples are often produced in the same factories as name brands. You're paying extra for a label, nothing more. These optimizations sound small, but they compound. Saving $20 per month on subscriptions, plus $30 on phone bills, plus $50 on insurance, plus $40 on groceries is $140 monthly, nearly $1,700 per year. That's meaningful money that can go toward goals instead of waste. Now let's talk about the first and most important goal, your emergency fund. An emergency fund is 3 to 6 months of living expenses kept in a safe, accessible account. This money exists for true emergencies: job loss, medical crisis, major unexpected repairs. It doesn't exist for vacations or sales or anything that could be planned for or avoided. Why is this so important? Because life happens. People get laid off, cars break down, furnaces die, pipes burst. Without an emergency fund, these events become crises that force you into high-interest debt. With an emergency fund, they're inconveniences you absorb without financial damage. The standard recommendation is 3 to 6 months of expenses. If you have a stable job with multiple income sources in your household, 3 months might be enough. If you're self-employed, work in an unstable industry, or are the sole earner for your family, 6 months or more makes sense. This money should be kept in a high-yield savings account. The national average savings rate at traditional banks is pathetic, around 0.4%. High-yield savings accounts at online banks offer 4% or more as of 2026. On a $15,000 emergency fund, that's the difference between earning $60 per year and earning $600. Same money, same accessibility, 10 times the return. There's no reason to leave money in a low-yield account. Once your emergency fund is established, you have a foundation. You can take risks because you have a cushion. You can invest without fear of needing to sell at the wrong time. You can negotiate harder at work because you're not desperate. Financial security isn't about being rich. It's about having options. An emergency fund is the first step toward options. Let's talk about the 12-month forecast. Most people budget month to month, and that's fine for maintenance. But to really understand your financial picture, you need to look at the full year ahead. A 12-month forecast forces you to anticipate the things that slip through monthly budgets: annual insurance premiums, holiday spending, wedding season gifts, vacation costs, back-to-school expenses, property taxes, vehicle registration. When you see the whole year, you can plan for these expenses instead of being surprised by them. You can set aside money monthly so that when November hits, you already have the Christmas budget saved. You can smooth out the spikes and valleys that derail monthly budgets. Building a 12-month forecast is straightforward. Start with your current situation, your baseline income and expenses. Project them forward month by month. Add in the irregular expenses you know are coming. Look at the results. Are there months where you'll be stretched? Can you move things around? Can you cut back somewhere to fund something else? This exercise transforms budgeting from reactive to proactive. You're no longer wondering where the money went. You're deciding in advance where it will go. Now, about that 20% for your future. Let's talk about what to actually do with it. Let's talk about savings versus investing, and when each one makes sense. Saving and investing are different things. Saving is putting money aside in safe, stable, accessible forms. Investing is putting money into assets that have the potential to grow over time, with some risk of loss. Money you need in the next 1 to 5 years should be saved in vehicles like high-yield savings accounts, money market accounts, or certificates of deposit. These won't make you rich, but they'll preserve your principal and provide modest growth. The top high-yield savings accounts currently offer around 4 to 5% APY, which beats inflation and keeps your money accessible. Money you don't need for 5 or more years should generally be invested. Over long time horizons, the stock market has historically produced returns that dramatically outpace savings accounts. The S&P 500, an index tracking 500 of the largest U.S. companies, has returned an average of about 10% annually since its inception. Over the last 20 years, that average has been closer to 12%. Over the last 10 years, it's been nearly 16%. Let me show you what that difference means over time. If you save $500 per month in a high-yield savings account earning 4%, after 30 years, you'll have about $349,000. Respectable. If you invest that same $500 monthly in an index fund earning 10% on average, after 30 years, you'll have about $1.1 million. More than 3 times as much money. That's the power of compound growth. Small differences in returns become enormous differences in outcomes over long periods. And the longer your timeline, the more powerful this effect becomes. Here's the critical insight from over a century of market data. Anyone who invested in the S&P 500 and held for a minimum of 20 years never lost money. In every 20-year stretch, the market delivered a positive return. Even in the weakest 20-year periods, returns exceeded 4% annually. 79% of the time, returns were 8% or higher. 59% of the time, they exceeded 10%. Short-term results are completely different. In any given one-year period, returns are wildly unpredictable. You might make 30%, you might lose 30%. There's no way to know in advance. This is why money you need soon doesn't belong in the market. Short-term volatility can devastate you if you're forced to sell at the wrong time. But long-term results are remarkably consistent. The market goes up over time because it represents ownership in companies that are collectively getting better at making money. Some companies fail, others emerge to replace them. The index self-cleans. Losers drop out, winners rise up. You own the winners automatically. So how do you actually invest? The simplest, most effective approach for most people is index funds. An index fund is a mutual fund or exchange-traded fund that tracks a specific market index. The most common is the S&P 500 Index Fund, which gives you ownership in 500 of the largest U.S. companies. When you buy shares of an S&P 500 index fund, you instantly own a tiny piece of Apple, Microsoft, Amazon, Google, and about 496 other companies. The alternative to index funds is active management, paying someone to pick individual stocks they believe will outperform the market. Here's the problem. This almost never works over the long term. In any given year, maybe 25 to 30% of active managers beat the index. Over 5 years, that drops to 10 to 15%. Over 30 years, it's essentially zero. The few who do beat the index over long periods usually aren't distinguishable from luck. Index funds have another advantage. They're cheap. Because they just track an index rather than paying analysts to research and trade, their fees are minimal. Many S&P 500 index funds charge less than 0.1% annually. Active funds often charge 1% or more. That difference sounds small, but compounds into enormous amounts over time. A 1% higher fee on $1 million portfolio is $10,000 per year, straight out of your pocket into the fund managers. The legend of index investing is Jack Bogle, who founded Vanguard in 1975 and created the first index fund available to regular investors. His insight was revolutionary at the time. Rather than trying to beat the market, simply own the market. Accept average returns. But here's the thing. Average returns, when captured at low cost over long periods, beat almost all alternatives. The most common recommendation you'll hear is VTSAX, Vanguard's Total Stock Market Index Fund. This gives you exposure to essentially every publicly traded company in the United States, over 3,600 companies in total. When you own VTSAX, everyone in those companies, from the factory floor to the CEO, is working to make you richer. That's the power of broad ownership. Now, how much should you be investing? The short answer is, as much as you can while still funding your emergency fund and necessary expenses. The more you invest, the faster you reach your goals. The math is straightforward, but worth understanding. If you need $1 million to retire, and you have 30 years to get there, you need to invest about $440 monthly, assuming 8% average returns. If you have 20 years, you need about $870 monthly. If you have 10 years, you need about $2,200 monthly. Time is your greatest asset in investing. Starting early makes everything easier. Every year you delay costs you, because that's a year of compound growth you'll never get back. Let's talk about retirement accounts specifically, because these offer tax advantages that accelerate your progress. A 401k is an employer-sponsored retirement account. You contribute pre-tax money, which reduces your taxable income today. The money grows tax-free inside the account. You pay taxes when you withdraw in retirement. For 2026, you can contribute up to $24,500 annually if you're under 50. If you're 50 or older, you can add an additional $8,000 in catch-up contributions for for a total of $32,500. If you're between 60 and 63, there's a super catch-up that allows $11,250 extra for a total of $35,750. Many employers match a portion of your 401k contributions. This is free money. If your employer matches 50% of contributions up to 6% of your salary and you contribute 6%, they add another 3%. That's an immediate 50% return on your money before any investment gains. Always contribute at least enough to get your full employer match. Failing to do so is leaving free money on the table. An IRA, individual retirement account, is another tax-advantaged option. Traditional IRAs work like 401ks, pre-tax contributions, tax-free growth, taxes at withdrawal. Roth IRAs are the reverse. You contribute after-tax money, it grows tax-free, and you pay zero taxes on qualified withdrawals in retirement. For 2026, IRA contribution limits are $7,500 annually, plus an additional $1,100 in catch-up contributions if you're 50 or older, for a total of $8,600. Which is better, traditional or Roth? It depends on whether you think your tax rate will be higher now or in retirement. If you expect to be in a higher tax bracket later, because you're early in your career and your income will rise, or because you expect tax rates to increase generally, Roth makes sense. Pay taxes now at the lower rate, enjoy tax-free withdrawals later. If you expect to be in a lower bracket in retirement, traditional makes sense. Get the deduction now at the higher rate, pay taxes later at the lower rate. If you're unsure, splitting between traditional and Roth gives you flexibility. Having some money that's already been taxed and some that hasn't lets you manage your tax situation in retirement. Here's a simple investing roadmap for most people. First, build a 1-month emergency fund, just enough for a basic cushion. Second, contribute enough to your 401k to get your full employer match. This is free money. Don't miss it. Third, pay off any high-interest debt, anything above 8% or so. The guaranteed return from eliminating that debt beats expected market returns. Fourth, build your emergency fund to 3 to 6 months of expenses. Fifth, max out your Roth IRA. The tax-free growth is powerful, and there are more withdrawal options than with a 401k. Sixth, go back to your 401k and increase contributions toward the maximum. Seventh, if you've maxed all tax-advantaged accounts and still have surplus, open a taxable brokerage account and invest there. This sequence isn't mandatory. Everyone's situation differs, but it's a solid framework for most people. Now, about risk. Different investments have different risk levels, and your portfolio should reflect your timeline and temperament. Stocks are higher risk, higher potential return. They can drop significantly in any given year, but they tend to produce the best returns over long periods. Bonds are lower risk, lower return. They provide more stability, but grow more slowly. A common rule of thumb: subtract your age from 110, and that's roughly the percentage of your portfolio that should be in stocks. So at 30, you'd be 80% stocks, 20% bonds. At 50, you'd be 60-40. At 65, you'd be 45-55. This is just a guideline. Adjust based on your personal risk tolerance and goals. The important thing is to stay the course. Markets drop. Sometimes they drop a lot. Since 1975, there have been multiple crashes exceeding 40%. During COVID, markets dropped over 30% in weeks. Every time people panic sold. Every time the market recovered and went on to new highs. The people who sold locked in their losses. The people who held, or better, bought more at lower prices, came out ahead. Your emotions are your biggest enemy in investing. When markets crash, every instinct screams to sell before it gets worse. That instinct is almost always wrong. Market timing doesn't work. Time in the market beats timing the market. The only way to capture long-term returns is to actually stay invested for the long term. This is why automation matters so much. Set up automatic contributions to your retirement accounts. Have the money pulled from your paycheck before you see it. Make investing the default. When the market drops, your automatic contributions buy more shares at lower prices. You don't have to make decisions in moments of panic. The system handles it. Let me address a common question. What about Bitcoin and other cryptocurrencies? Crypto is speculation. When you buy crypto, you're betting that someone will pay more for it in the future than you paid today. There's no underlying business generating profits. There's no productive asset creating value. There's just supply and demand, and sentiment, and speculation. That doesn't mean crypto is worthless or that no one has made money on it. People have made extraordinary returns on crypto, but they've also lost everything on crypto. The volatility is extreme. The regulatory environment is uncertain, and there's no century of data showing consistent long-term returns like we have with stocks. If you want to speculate with a small percentage of your portfolio, money you can afford to lose entirely, that's your choice. But don't confuse speculation with investing, and don't put money you need for actual goals into assets whose value could go to zero. Now, let's talk about two of the biggest financial decisions most people make: buying a car and buying a house. Transportation is typically one of the top 3 expenses in anyone's budget, often consuming 15 to 20% of annual income. And it's one of the easiest places to destroy your finances without realizing it. The average monthly payment on a new car in 2026 is around $770. More than 20% of new car buyers are committing to monthly payments over $1,000. 22% of borrowers are taking out 84-month loans, 7 years of payments on a depreciating asset. The average new car loan is nearly $44,000. Let me show you what this actually costs. Say you're paying $750 monthly for a car. That's $9,000 per year. Over a 6-year loan, you'll pay $54,000. But the car will be worth maybe $15,000 to $20,000 when you're done. You've lost $35,000 to depreciation. And that's before you factor in insurance, which averages over $200 monthly for full coverage, plus gas, maintenance, and repairs. Now imagine an alternative. Instead of that $750 payment, you buy a reliable used car for $15,000 outright or finance it for 3 years at $300 monthly. The difference? $450 per month goes into an index fund averaging 8% returns. Over 30 years, that monthly investment grows to over $670,000. Every expensive car you buy is a trade. You're trading future wealth for present transportation. That's your choice to make, but make it consciously. Understand what you're giving up. Here are guidelines for car buying that keep you out of trouble. The 24-10 rule. Your down payment should be at least 20% of the car's price. Your loan term should be no more than 4 years. And your total car expenses, payment, insurance, maintenance, should be no more than 10% of your monthly income. If you can't meet these guidelines, you're looking at too much car. Scale down until the numbers work. Better yet, buy used. A new car loses 20 to 30% of its value the moment you drive it off the lot. A 3-year-old car has already taken that depreciation hit. You get 80% of the useful life for 50 to 60% of the price. Let someone else pay for that new car smell. Best of all, pay cash. This requires patience and discipline. You buy a modest car you can afford outright. You drive it while making car payments to yourself, putting that money into savings every month. When the car needs replacing, you buy the next one with cash from your car fund. You never pay interest. You never have a monthly payment. You own your transportation free and clear. This is how wealth-building people handle cars. They don't see vehicles as status symbols. They see them as tools for getting from point A to point B. They optimize for reliability and total cost of ownership rather than newness or impressiveness. They understand that every dollar spent on a depreciating asset is a dollar that can't compound into future wealth. Now, let's talk about the biggest purchase most people will ever make: a house. The rent versus buy debate is more nuanced than most people realize. Buying isn't always better than renting. Renting isn't always wasting money. The right answer depends on your circumstances, your timeline, and the math in your specific market. Here's the thing most people miss. When you buy a house, you're not just paying the purchase price. You're paying the purchase price plus a mountain of additional costs that don't exist when you rent. Transaction costs when buying, inspection fees, closing costs, legal fees, possibly points on your mortgage. These can add up to 3 to 6% of the purchase price. That's $15,000 to $30,000 on a $500,000 home. Money you pay once and never see again. Ongoing costs, property taxes, homeowners insurance, maintenance and repairs, possibly HOA fees. The rule of thumb is 1% of your home's value annually in maintenance. On a $500,000 home, that's $5,000 per year. Some years less, some years much more when the roof needs replacing or the HVAC fails. Opportunity cost. The down payment you put into the house is money that's no longer invested elsewhere. If you put $100,000 into a down payment instead of the stock market, you're giving up whatever those investments would have earned. When you rent, your costs are much simpler. Monthly rent, renter's insurance, maybe utilities. Your landlord handles property taxes, maintenance, repairs. Your capital is free to invest elsewhere. Here's an example of how to think through this decision. Say you're considering a $400,000 house with a 20% down payment, $80,000. You'll need a $320,000 mortgage. At 6% interest over 30 years, your monthly payment would be around $1,900 for principal and interest alone. Add property taxes, insurance, and maintenance, and you might be looking at $2,700 total. Alternatively, you could rent a comparable place for $2,000 monthly. The $700 difference, plus the $80,000 you would have used for a down payment, could be invested instead. After 10 years of investing that $80,000 plus $700 monthly at 7% returns, you'd have roughly $230,000. Meanwhile, the house might have appreciated, but you've also spent money on maintenance, transaction costs, and interest that a renter avoided. The math depends heavily on how long you'll stay. The longer you stay, the more buying makes sense. How much homes appreciate in your market, what your mortgage rate is, what your rent would be for a comparable property, what returns you could get on invested money instead. As a general rule, if you're staying less than 5 years, renting usually wins. Transaction costs and early mortgage payments, being mostly interest, eat into any appreciation gains. If you're staying more than 7 to 10 years, buying often wins, assuming you're buying a reasonably priced home in a market with decent appreciation. There's also the psychological component. Owning a home provides stability. You can customize your space. You can build a connection to a community. You're protected from rent increases and landlord decisions. For many people, these intangible benefits are worth some financial cost. The key is to run the numbers for your specific situation rather than blindly accepting the conventional wisdom that buying is always better. Sometimes renting and investing makes you wealthier. Sometimes buying builds equity and stability. There's no universal answer. Now let's talk about protecting what you've built. Let's talk about insurance. Insurance is risk transfer. You pay a premium to an insurance company. In exchange, they cover certain losses if they occur. You're trading a small certain cost, the premium, for protection against large uncertain costs. Medical bills, car accidents, lawsuits, home damage. The main types of insurance most people need. Health insurance is non-negotiable. Medical expenses in the United States can be catastrophic. A single hospital stay can cost tens of thousands of dollars. A serious illness or injury can run into hundreds of thousands. Without insurance, a medical emergency can wipe out years of savings and put you into debt that follows you for decades. If your employer offers health insurance, that's usually your best option. They typically pay a portion of the premium. If you're self-employed or your employer doesn't offer coverage, explore marketplace plans, spouses plans, or healthcare sharing ministries. Whatever you do, have coverage. Auto insurance is legally required if you own a car. At minimum, you need liability coverage. This pays for damage you cause to others. Beyond the minimum, consider collision coverage, pays for damage to your car in an accident, and comprehensive coverage, pays for non-collision damage like theft, weather, or vandalism. The higher your deductible, the lower your premium, but the more you pay out of pocket when something happens. Homeowners or renters insurance protects your property and belongings. Homeowners insurance is required by mortgage lenders. Renters insurance is optional but smart. It's cheap, often $15 to $30 monthly, and covers your possessions if they're stolen, damaged by fire, etc. It also includes liability coverage if someone is injured in your home. Life insurance is important if anyone depends on your income. If you die, life insurance provides money to your dependents. The simplest and most cost-effective type is term life insurance. You pay for coverage for a specific period, 10, 20, 30 years. And if you die during that period, your beneficiaries receive the death benefit. How much coverage depends on how much income you're replacing and for how long. Disability insurance is often overlooked but critical. It replaces a portion of your income if you become unable to work due to illness or injury. Your ability to earn is your greatest asset, especially early in your career. Check if your employer offers disability coverage. If not, consider a private policy. The general principle with insurance: protect against catastrophic losses you couldn't absorb. Don't insure small losses you could cover yourself. Extended warranties on electronics, for example, are usually poor value. The point is to prevent financial ruin, not to avoid every possible expense. Now, a word on scams and protecting yourself from fraud. Financial scams cost billions of dollars annually. They're becoming more sophisticated, especially with AI enabling more convincing fake communications. The best defense is awareness and skepticism. If something seems too good to be true, it is. Guaranteed returns of 20%? Scam. Secret investment opportunity that you need to act on immediately? Scam. Nigerian prince with millions to share? Obviously scam, but people still fall for it. Never give out personal information. Social security number, bank account numbers, passwords to anyone who contacts you. If your bank calls asking for information, hang up and call the number on your card. Legitimate organizations don't ask for sensitive information through unexpected calls or emails. Be wary of pressure tactics. Scammers want you to act before you think. Any legitimate opportunity will still be there after you've had time to research and consider. If someone is pushing you to decide immediately, that's a red flag. Protect your accounts with strong, unique passwords and two-factor authentication. Monitor your credit reports for accounts you didn't open. Freeze your credit if you're not planning to apply for new credit soon. This prevents anyone from opening accounts in your name. The emotional component matters here. Scammers exploit fear, greed, and urgency. They catch you when you're vulnerable. The best protection is a habit of pausing before acting on any financial communication that triggers strong emotions. Sleep on it. Talk to someone you trust. Research before you send money or share information. Finally, let's talk about taxes briefly. Taxes are a huge topic that varies enormously by situation, and I won't pretend to cover everything here, but a few principles matter. Understand your marginal tax rate. This is the rate you pay on your last dollar of income. If you're in the 24% bracket, reducing your taxable income by $1 saves you 24 cents. This is why tax-advantaged accounts like 401ks and traditional IRAs are valuable. Contributions reduce your taxable income today. Use tax-advantaged accounts first. Before investing in taxable accounts, max out your 401k match, your IRA, possibly an HSA if you're eligible. These accounts shelter your money from taxes in various ways, accelerating your growth. Don't let taxes drive decisions entirely. Sometimes people avoid selling investments because of capital gains taxes, even when selling would be smart. Don't hold on to a bad investment to avoid taxes. The tax on gains is only a portion of the gains. You still come out ahead. Keep records. Track what you contribute, what you earn, what you can deduct. Good records make tax time easier and prevent mistakes. Consider professional help if your situation is complex. A good accountant or tax preparer can catch deductions you'd miss and ensure you're compliant. The cost often pays for itself in savings. We've covered a lot of ground. The snapshot of where you stand, the mechanics of debt and credit, the importance of goals and budgeting, the power of compound growth through investing, the major purchases that can make or break your finances, the protections you need against risk and fraud. But knowledge without action is just entertainment. The question now is, what will you do with this? Here's a suggested path forward. This week, Calculate your net worth. Add up your assets, subtract your liabilities. Know the number. This week, track your income and expenses. Use an app, use spreadsheets, use whatever works. Get clear on where your money actually goes. This month, set up automatic transfers to a high-yield savings account. Start building or reinforcing your emergency fund. This month, if you have an employer-sponsored retirement account, confirm you're contributing at least enough to get the full match. Increase your contribution if you can. This quarter, list all your debts with balances and interest rates. Choose avalanche or snowball. Make a plan. Start executing. This year, set specific financial goals with timelines. Calculate what you need to save and invest monthly to reach them. Automate those contributions. Ongoing. Review your finances quarterly. Are you on track? What needs adjusting? Keep learning. Keep improving. The gap between financial literacy and financial success is action. Knowing this information puts you ahead of most Americans. Implementing it changes your life. Remember the numbers from the beginning. The average American loses nearly $1,000 per year to financial illiteracy. That compounds into hundreds of thousands over a lifetime. You've just invested an hour into closing that gap. The return on this investment, if you act on it, will be enormous. The people who build wealth aren't necessarily smarter or luckier. They're more intentional. They understand the rules of the game. They build systems that work in their favor. They make conscious choices rather than drifting on defaults. You now understand the rules. You have the framework for building the systems. You know what conscious financial choices look like. The ground doesn't have to crumble beneath your feet, but you have to stop walking toward the cracks. If you're just starting out, you have time. Use it. Even small amounts compound into significant sums over decades. If you're further along and feel behind, you still have time, just less of it. Be more aggressive. Cut what doesn't serve your goals. Maximize your tax-advantaged contributions. Prioritize building wealth over displaying lifestyle. The traps are real. The system often works against you. The education you needed was never provided, but now you know. And knowledge combined with action is the path out. You've made it to the end. That already separates you from most people. Take what you've learned and build the financial life you deserve. The simple path to wealth. Spend less than you earn. Invest the surplus. Avoid debt that doesn't serve you. Let time do the heavy lifting. It's straightforward. It works. And now you know how.